Right, let's continue the market conversation now with Anna Han, Wells Fargo Securities Equity Strategist. Good to see you, Anna. So in terms of what you're viewing right now, in terms of some of these outlooks that we're seeing, a lot of different estimates as to where we might see the S&P go perhaps next year. What are some of your outlooks?
Well, we're with the consensus in the sense of caution. Everyone on the street right now is being cautious because what we want to see is what does the data say? Like you said, the Fed has been data dependent, and much of last year was macro driven, depending on monetary policy tightening pace, depending on what yields were doing, and depending on what inflation expectations are doing. That's really what was shaking equities back and forth, particularly because some of the large cap indices that we track in the US are more growth exposed. They're more growth oriented, more tech heavy, and they tend to be having that duration risk. So for our outlook for next year, we too are pretty cautious going into the beginning of the year. We think yields could actually go back up the 10-year closer to 4%, weighing on equities. But as we get maybe some relief from the Fed stopping in the back half of next year, that could help that recovery that a lot of people are hoping for.
Yeah, what is the expectation on your end in terms of whether the dollar is likely to move? I mean, do you buy this argument that we're likely to see one last rally before we start to see a pullback on some of those recessionary concerns?
We would agree generally with that, Akiko. When you think about what the dollar really is driven off, it's yields. But what we have to be careful here is yields are broken into those two components. You have the inflation expectation or break evens, and then you have real yields. Right now, that inflation expectation has come down pretty aggressively as we've seen a bit more of a downward trend in CPI prints. But yet, we don't think the Fed is going to be that quick to pivot from a slowing and tightening to a full easing or a cutting. And that pause as well needs to get repriced. So we are likely to see, in our view, that yields go up a bit higher in the beginning of the year before they really start to fade again towards the back end of the year, driving the dollar weaker more towards in the second half.
And Anna, how do you think investors are pricing this in at the moment, if at all?
Well, I think what they're thinking about right now, the focus is shifting from a little away from the yield story, still very important, but is how is this going to impact corporate earnings? In the end, the reason why we think about the dollar is it's sort of telling us what are corporates and companies here who have international exposure going to be at risk for. And the main driver I think investors are betting on is the consumer. The consumer is looking to weaken a bit next year because they've drawn down a lot of that excess savings, drawn down some of their savings rate, but they continue to spend. But as they shift that spending and decide to really trade off between durable goods and more experiences, World Cup, Super Bowl, holiday travel, these are kind of things that if people continue to spend on, we might see a less of an earnings contraction and still some hope for corporate growth in certain parts.
So Anna, with that said, I mean, what does your portfolio look like going into 2023? Are we going to continue to see some of those sectors that really dominated this year, like energy, lead the way? Or could we potentially have some sectors that are being overlooked right now?
I think you have both there, Akiko. I think energy, though, is going to be more dependent on really the global situation with Europe's energy crisis, how they handle the winter and prepare for next year's summer. But when you look at other parts of the market, for example, we talked about yield impacts on growthier sectors. We're looking again carefully at tech. Tech's had a tough run this year, but places that might have a turnaround, and we're getting a little more positive rather, or looking more at software where services could be that service spending helping those kind of parts of the market. In particular, if the consumer doesn't catch frostbite this winter and spends, then we could see some of these more cyclical, but also still more growthy aspects of the market come back. That's what we're looking at. And with the chances of the Fed being able to hopefully achieve a less hard landing, I think that raises the chances to step away from the more durable goods, more away from food, beverage, and tobacco. So we've downgraded that sector as well.
Yeah, some good takeaways with just one more week to go here before the new year. Anna Han, Wells Fargo Securities Equity Strategist, appreciate your time today.